Thank you very much for everyone inviting me, and good morning. So I'm going to talk a bit about online convex optimization and how that can be used in the financial industry, and in fact a little sort of insight into some ongoing research at Cantab. So firstly, what am I going to talk about? So I'm going to sort of give a sort of very brief, very sort of high-level overview of what asset management is. I mean, what are the sort of problems that we care about, and how do we go about solving them, sort of generally, and you know, and then also so then I'm going to go on to the online convex optimization (OCO), and this is a technique that's really sort of existed for at least 30 years or so, and in fact the first application to finance was in a paper, that I know of, in a paper in the early 1990s by Thomas Cover, and since then there's been some sort of burbling interest in the literature. There've been developments, new algorithms and improvements, but it's not really something that has ever been considered mainstream in finance in our industry. So what I'll do is sort of just give a sort of an introduction to some of the methods that are in the literature, the kind of guarantees that you can expect to see from them, and then apply it to a relatively simple case, a portfolio construction problem, and sort of just show empirically how these guarantees might actually translate to some kind of useful performance that an investor might care about. So what is asset management? What is my job? All of our jobs at Cantab. So we have investors who entrust us with some of their money, and what they want is for us to manage it in such a way that we will hopefully generate them some positive return, but controlling risk factors, because we'd expect to make returns from exposing ourselves to certain risks and things that we think we have some understanding about, but we don't want to have exposure to risks that we don't have any prediction about. I mean, we don't want to be exposed to, say, an uncontrolled Brexit scenario. I mean, that's something we'd want to think about and not have exposure to. And then, so that's sort of already two things. We need to sort of predict what our returns might be. We need to predict how sort of different assets, different instruments we might invest in might be related, how they might be affected by certain things in sort of the global markets. But of course, all of these things are changing over time. So the third sort of piece of the puzzle is trading, and actually how do we implement this portfolio in an ongoing fashion efficiently, optimizing costs, and well, that's a whole other sort of can of worms. So Cantab's a systematic manager. There's obviously discretionary managers as well, but we take the opinion that we want to build models. We want to build mathematical models that describe different pieces of this puzzle and then put it together into some system that will sort of be responsive, be dynamic, and hopefully make everyone, all of our investors, happy. So the kind of models that we use are, well, we want to predict returns, and there's various ways that we might do this. I mean, broadly you'd classify this as regression problems, so we might take in some data, so we'll look at historical prices, behaviours, trends in the market, indicators that certain things are undervalued, things are cheap, and we'll sort of put all of these together and then try to get some indication of how we think assets are going to behave over the next day, over the next week, over the next year, and from that sort of make a prediction. So the other thing is risk, and there is a lot of components to this, and when we think about risk, we might think about sort of a process, some kind of Markov process. So that can be described, say, by volatility. So you might have different methods for estimating that. Garch is one technique. But obviously, we live in a world where we don't just have Gaussian noise. We have bigger moves than that. So we'll want to estimate tail risk, so the probability of some much larger move than you'd expect from a Gaussian distribution. And then, of course, we're not just investing in one thing. We have a whole portfolio of things. So we need to consider correlations between those things. How those correlations will change over time. How, in times of sort of high risk, those correlations might increase. And again, we have there are models that we can use to take those things into account. And then, portfolio construction, given all of this information that we've just got, how do we actually decide what we want to put our money into? And there's various ways of doing this, risk parity being one, and many others. And then, once we decide what position we want to take, we know we have some position right now, so we need to change our position. So, we need to implement trading algorithms. And there are sort of simple algorithms that we can use, but a whole host of different things with different parameters we can tune. And one of the things we do is use a multi-arm bandit scenario where we take in sort of market condition indicators and then say, which algorithm, which set of parameters do we want to use when actually performing our trades. So, all of these, there's a whole host of different problems here, but there are some sort of key underlying issues that we face. And I think those are these three here. I mean, market conditions are not stationary. I mean, things change over time, so we need to be adaptive. We also need to have be able to test our theories historically in a computationally efficient way, but most importantly, we're not allowed to use future data before we would have had it. I mean, that's we call it future peaking, but like in the case where you'd have in sort of some machine learning problem, you'd have some training set, some validation set, some test set. It's even more extreme. I mean, effectively, you have all of your data points are time ordered, and for predicting at any one point in time, you can only use stuff that happened before that. So all of our algorithms need to be designed with that in mind. And finally, not only can markets conditions change, but they're adversarial. I mean, you put in a big trade and someone will realize, I think they're going to keep trading in that direction. Let me just do something so that you'll get penalized. So that this is sort of a very sort of thorny problem. So on that topic, sort of a war story from back in 2008. So these are the S&P 500, so that's one of the large US equity indices. So these are the sort of bid and ask prices at some point in January, and we see, the time, these are of order minutes sort of going along here, and things are sort of moving along nicely. And then at some point soon after, you then see this, which is going completely crazy. And in fact, what had happened here, there was an algorithm in the market that had gone a bit haywire, and this represents some particular company losing a very lot of money. And actually, this was, about 10 minutes or so. This is 6 seconds. So yes, things can change very quickly in the markets. So we have these problems. Now, OCO can actually, I would say, provide some benefits in all of these respects. So what is online convex optimization? So if any of you have done machine learning, particularly reinforcement learning, this would all be sort of reasonably familiar. But you have a setup with an actor and some environment. And, well, we start off by making actions. So we have some action here. So I'm labeling this as W1. And this action is drawn from some convex set. So that's the first departure from just sort of standard reinforcement learning, this convexity. And so, we say, well, this is what we did, and then the environment responds, and it says, here's a loss function. And in principle, in the full OCO setting, we can actually see all of this function here. So not necessarily just the point at which we actually acted. And so then we continue. So this is, again, this loss function must be convex. So it's a convex function on a convex set. And then it responds with loss, and then we rinse and repeat, and then we give another action, and now the environment responds with a different loss function. So there's no reason that these two functions must be the same. So broadly, our objective is to minimize our loss. So why is this setting relevant and useful to us? Well, it's naturally suited to sequence prediction. I mean, it's modeling the case where we're making actions and then the environment is responding. I mean, this is exactly the kind of scenario we have in time series analysis. We're making minimal assumptions. We don't, other than the convexity, we're saying, the functions can effectively be anything. And in particular, they need not be stationary. They can vary over time. And there's also no assumption here that the environment is now to look at what you're doing and tune their loss function if they want to. So there are various algorithms that exist in the literature to use this, and they differ basically in terms of what information they use from the loss function you're given. So the bandit case is actually one special case of this, where you don't look at anything other than the point at which you actually made your action. I'm not going to talk about that here, but that's a very interesting case. The first order case, which is what we'll develop a bit more, is where we just use the value and the gradient. And then you can also consider using higher order gradients, but we won't look at that here. And then, well, what does our what does our action space look like? Is it some simplex, probability simplex, or unit ball, etc., etc.? And some algorithms are designed for particular cases of that. So now I'll just introduce the setting in which we'll see an example, which is the asset selection. So we assume that we have some basket of n assets, and an asset is a thing which has a price, and prices we assume to always be positive. So this is the no junk bond assumption. And so for every time t, and over every interval t to t plus 1, we can define a return, which is just the ratio of the prices. And then what we want to do is choose some long only, I'm saying, so we're not shorting assets here, some portfolio from the probability simplex, and then we can consider the returns of that portfolio. And we'll do this in log space, so log returns. So we have our portfolio dotted with all of our returns for each asset. Take a log, sum over all time, and then the exponent recovers this product here. So the cumulative loss we'll just define to be minus the log of our cumulative return, our product return. And so at each step we can say that basically the minus this thing inside the sum is our step-by-step loss. Now, we can say that what we want to do is minimize our loss, but in practice, we are never going to be able to minimize our loss at every time step. That's just unrealistic. So in the OCO setting, but they come up with this term called regret, and regret is the difference between your own loss and the loss of the best particular action, constant action you could have taken with the benefit of hindsight. So this is what it would look like. So we've got some x star, which is some constant that we're minimizing over all time, and then our regret is the actions that we actually would have taken. And so this is already a useful thing. So we're saying that even though step by step we can only see what we've done before, when we get to the end, that we're going to get some bound that is saying what would our performance have been relative to if we'd have had all of that information in advance. And so algorithms exist which will provide bounds on this, which are sublinear, which means that we're learning useful information. Our regret is not just sort of constantly increasing with time, but actually it's tailing off. We're learning things, and typically this will be of order square root t, or with some algorithms of order log t. So one other thing is that we can actually rescale this. I'll use this later. Effectively, if you rescale the asset returns, you can ensure that at any point in time your maximum return is 1. I'll use this in just a bit later. So let's take an empirical case study here. So we're taking some energy futures contracts. Now, a futures contract is a thing that you make with an exchange or with another party, and you say that I promise at some particular specified date in the future to buy or sell so much of a certain commodity, so say 100 barrels of oil. Now, sitting in the office in Hills Road, I do not want to get 100 barrels of oil. That would be bad. So instead, we roll these things. What we do is we say, well, we take a futures contract that expires next month, hold it for a while, sell it, and then trade into one that expires later. And if you keep doing this, you effectively get a continuous time series of prices, a thing that you can trade. And what this represents here, this plot, is the cumulative returns you would have got from holding that kind of rolling position in one of all of these markets. So a couple of different crude oil markets, natural gas, gas oil, heating oil, reformulated blend stock. And what we see is that actually all of these markets look quite similar. So we've got 5 things there that are all very similar, and then we've got one outlier here, which is natural gas. So what we're going to do is say, well, let's allocate some portfolio between these sets of things, and hopefully not invest at all in natural gas, because that would be bad. So first algorithm we'll look at is online gradient descent. That's very similar to stochastic gradient descent, and effectively all that's saying is, well, we have some point in our space, some x, we get our loss function, we get the gradient of our loss function, and we move by some learning rate step so as to minimize that. And then we also have this projection step. So if you remember, our action space is some convex set. So our gradient step could take us outside that set. If so, we just project back into the set. And if we do that, then, and you read the papers, then it says you have some bound on regret. And it says that, and in this case, our regret is the difference between our realized total return and in log space and the return of the best constant portfolio. And well, we'll see it has a log t dependence, so that's good. And then it's got some constant factors out here, which we'll see they kind of depend on our realized returns. And effectively what this is saying is that if we have quite big returns, either sort of big positive or big negative returns, then this gradient will be much larger, and our bound is going to get worse. And well, we can run the algorithm, we can see what happens, and well, it's doing something a bit interesting. So we see here that this bound is obtained with this choice here of a decaying regret and decaying learning rate, and that's what happens here. And it seems to learn very quickly at first, and then it sort of stagnates over time. So in practice, although there is a bound, the bound isn't all that useful. What we can see are these bold lines. There's a pink line here and a grey line. The grey line is if you just put equal weight in everything, and the pink line is sort of kind of keeping track, but it's not really giving you anything. So, and this is the other thing I think you should say. With financial research, it's very often it's marginal gains that you're making, and particularly in this kind of simplified example, beating a constant benchmark is not always trivial. So there is some lack of adaptivity. So we can look at another algorithm. In this case, we've got online Newton step, which is somewhat similar to Newton-Raphson techniques, and the main difference is to just a simple gradient descent that we use Hessian information. So we've got this del squared of our log return, and I won't go too much into it, but the projection as well is a bit more complicated. We actually take into account this matrix of the cumulative Hessian. And this is more computationally expensive. It has different bounds though. In this case, with some appropriate choice of parameters, you can actually get a regret like this. And well, what we might be slightly suspicious about is this n. So this is the number of assets, and this is saying that our regret is actually increasing more than linearly with that, which means that adding more things could in principle mean that we do a lot worse. The other thing that we'll see is, again, we have an alpha. So here alpha is this market variability parameter. Again, it's encoding how variable our returns are. If we have and again we have the log t dependence here. And so if we put this in, then we get very different results. So on the left-hand side, we have the weights that we're putting, our portfolio composition, and these are moving around a lot more if we compare to there. These are all sort of stagnate very quickly. In this case, we're much more responsive, and yes, it doesn't really seem to help us in practice. And well, one of several problems here is, in fact, the choices of parameters. So this algorithm has effectively two. One is just used in analysis, but two parameters which can actually significantly change what this algorithm does, which then gets back to future peaking. How do you choose these parameters? So that then leads me just to sort of a slightly different regime where there exist some algorithms which have some other useful properties. So that's the expert learning setting. So the expert learning is where we have, again, some action set as a simplex, but this time our loss function is much more specifically defined. So we have a set of experts, each of which at every time step will emit some loss, and all we can do is weight between those experts, and our loss will be just the linear sum. And then there's a special case of this known as the hedge setting, which is where not only is the loss function of this form, but each of these losses is in 0, 1 for every expert. And there's a few algorithms that exist for this. So the multiplicative weights is probably the simplest. Normal hedge, add a normal hedge, and then squint. And squint is what I'm just going to talk about now for the rest of the talk. So it's quite a recent algorithm by Cullen and Van Erven, 2015, that solves the hedge setting. But it has a few additional properties that are quite nice, particularly considering what we've looked at just now. So firstly, it's parameter free, pretty much, which means that we're not having to try to choose some learning rate. We're not having to choose some other tuning parameter that might significantly change the behavior of the algorithm, and means that we then are back into the future peaking problem. And it's also giving us this second order bound. And this is interesting because, well, what we've seen before is that we've had algorithms which have bounds in the adversarial case, but in a case that we've been looking at, which is maybe slightly adversarial but mainly stochastic, in practice the performance can be worse. And finally, it's a quantile bound, and I think that's what the squ in squint is about, and that's the saying that we're actually putting regret against not just single experts, but against all subsets of them. And so what does the algorithm look like? Well, a few other terms to define. So we've got some instantaneous regret against a particular expert, K, at some point in time, and then the cumulative version of that. And then effectively what we're doing is, well, so we have some exponential, so this is weighting a particular expert, and then this term here is some difference between the regret that that expert's seen so far, but then this V term, and this V is the cumulative variance. So what does the square of these regrets look like per expert? And then the really interesting thing about this algorithm is that then we do this expectation with a prior over our learning rate. So we're not just picking one learning rate and saying, choosing a bound, we're actually going to do an integral over that. And similarly, we take the expectation, so we're taking some combination of experts. So we're taking this prior over experts. Typically that would just be some flat prior. And well, if you do that, it turns out you can do the integral analytically, and the authors very kindly on their websites give numerical implementations, so you can run experiments very nicely. What's interesting about this? Well, I think the most interesting is really the form of the bounds. And so the bounds, so this regret here, so this is actually some regret on some subset of experts, and this is true for all subsets of experts. And this is kind of ignorable, but the really interesting thing is this term here. So we've got this root of 2 VTK. And this is saying, well, and this is our expected variance, so the variance being the squares of the residuals. So if we have experts that are very consistent, have consistently low regret, then that variance term will be small, and our regret will hence have a tight bound, which is nice because that's what you'd expect from a stochastic sort of not strongly changing case. You've also got effectively a t embedded in this, because this is summed over all time steps, so this is again scales like root t. And well, but if we remember, this is not quite, if we go back, this isn't quite the setting that we had. What we had was a log of this. That's the case we're interested in. Well, we can do an approximation. So we can say that if we use our scaled returns, where our maximum return is 1, then we say, well, if the returns tend to be small, then we can write them as 1 minus some delta, and then we can approximate our log with just 1 plus that, and then we get this, which is the hedge setting. So via this approximation, it's not perfect, but it is good enough. We can then get some practical results. So what we see first in our weights, well, they're much more conservatively near equal weights. So this is our equal weight line, and then some of them get bigger, some of them get smaller. But nicely what we see is that this one actually seems to give some consistent benefit over time. So like the other ones were sort of dipping below the grey line. This one is sort of slightly improving. And if we look at this and just subtract off that constant benchmark, then we can see how these different algorithms are performing. So we've got firstly the gradient descent in blue, and then the Newton step in green, and then squint in red. And of those, the quantile bounds and the stochastic bounds that you can get with squint is useful. And so, and effectively, this is sort of coming towards the end of sort of the basic introduction that I'm sort of giving here. But there's a lot more that's interesting, and I think we're looking at, and that's partly adaptive regret. So I'd say what we've looked at here are sort of regret at the end of time towards the best fixed thing with hindsight. I mean, it turns out that you can actually take any such algorithm and make it have bounds on any subset of time as well. So that's definitely sort of interest in finance. Second order bounds in the general case, so not just in the expert setting, but for general OCO, so there's an algorithm called Metagrad. And then probably most importantly is then actually including side information. So here we've only just been using historical returns to decide what we're going to do, what things to put our investment into. But there's a lot more information that you can and should be using, and there's a lot of techniques that can be used for that as well. And that's it. So thank you very much.
Are there any questions for Tom?
Do you have any constraints? Is there any cost to the actions that you take?
Not in, so you can do. So not in the algorithms that I used here, but then in there's definitely literature for sort of doing the optimization case in the case where actually moving between states has some cost associated with them, which would approximate trading costs, and you can still get bounds in that case.
I imagine you have to make an assumption.
Yeah, you have to you have to assume some form that the costs will take, and assume what those costs will be, and so typically some sort of linear cost model, so that moving some position by some fixed amount will give a proportional cost. Typical assumption. But you might also have sort of fixed costs as well, so that any movement, any deviation from not staying the same would have some fixed costs as well. Chris?
Is regret actually what your clients care about?
In some, well, yeah, that's a good question. It is completely missing the risk aspect in this case. So here regret is on the total return, but I think you can phrase other quantities rather than just so here the loss is the return, but what you could talk about instead is some more risk-based measure, and then you'd have a regret of some risk over some constant thing, at which point the regret is then interesting from that point of view. Not that this isn't interesting, but I think it's easier to consider this case.
Just following up on Chris's question, that a lot of, not everybody builds products just to invest in financial markets, right? So a lot of products also are about tracking benchmarks, right, and trying to outperform them. I'm just wondering, and then your regret would obviously be could have been in the benchmark, the MSCI World or some equity index. Instead, you have some active investment. Is that actually a natural analogue of the?
I think so. Yeah. I guess the difference here is that
those investors would care about exactly that. Right?
Yeah. So in this case, we're considering regret against some thing which is not predefined. So against sort of the best actions that you could have taken. Whereas I think what you're describing is sort of you actually have some reference that you can use. But I don't see any reason why you wouldn't be able to adapt this for that. I think, yeah.
All right, let's thank Tom once again then.